Hello. Greetings from Miami, Florida. This is Jason Smith with the Showcase Miami team, otherwise known as Jason Smith Showcase, showcasemiami.com with Keller Williams Capital Realty. We're here for our monthly MREI Real Estate Investor webinar. What does MREI mean? Millionaire Real Estate Investor. It's a book that was written by Gary Keller, the co-founder of Keller Williams Realty, one of the largest real estate companies in the world, the largest real estate company, as according to how many agents and dollar production and units sold. And basically, this is a book where he was studying investors. He was interviewing investors, some of the best investors out there, real estate investors, to see what their playbooks were. How did they approach the business of real estate investing? And if you were to just ask many investors out there, which I've asked many investors, the book that you hear the most often, which is the book that when they say, what's the best investment book that you've heard? This book, I would say 80% of the time, is the one that you hear people saying. Millionaire Real Estate Investor by Gary Keller is the book that comes up. So it's Gary Keller with Dave Jenks and Jay Papasan. So what my plan here in the next hour or so is to go through some of the points in this book to share with you the key lessons from this book so you can really get a flavor for the book. Of course, there's nothing that substitutes for actually reading the book. And I would suggest reading it often, as I have been doing, so that you can have the material wash over you and you can really get acclimated to it. Because one reading, in my opinion, is not enough. A little bit about me. My name is Jason Smith. I'm a real estate agent here in Miami, 22 years in the business. I have also been investing and seeing and working with investors in that 22 years. So my goal here is to not only share the theoretical part of the book, but also as an agent who's been in the trenches here for 22 years, to share with you what I've seen other investors and what I've done, mistakes that I've made along the way, some home runs that I've had. So perhaps that will be enlightening for you. And if it helps you to get motivated to buy another property, fantastic. If it helps you get motivated to buy your first property, fantastic. Here to help, here to educate, and I really hope you enjoy the material as much as I enjoy sharing it, because there's some really behind me if you ever have any questions about real estate, Miami real estate in particular. Share screen. Okay. All right. And we have Zyrel, my assistant. She's here with me. Are you there, Zyrel? Can you say hello?
Yes, I'm here.
Great, Zyrel. Do you see our screen, Millionaire Real Estate Investor, on the screen, the PowerPoint?
Yes. Yes, it is.
Fantastic. So this is the book, folks. This is the book. I'll tell you, the first one thing to notice is that in this book, it's not just about the mechanics of investing. The first 125 pages of this book is about the mindset of an investor. See, it's psychology. The mindset of an investor is much different than the mindset of a non-investor. So it takes 125 pages to really dissect the mindset of an investor. If that's not an aha, I don't know what is, because an investor will discover has a different mindset. So let's move forward. Not anyone can do it. Not everyone will. Will you? That's the question. It's a best-selling book, as you can see here on the screen. A little bit about myself. I'm a broker associate, like I mentioned. I've been in the business 22 years. I've been a real estate investor. I've bought and sold $5.4 million in real estate myself. And I serve Miami, as I mentioned earlier. My cell phone is here, 786-326-8115, 786-326-8115. And the website is showcasemiami.com if you'd like to see our listings that we have. Okay, so why are you here today? Any burning questions that come up? And feel free to put it in the chat right there. And Zyrel, what does somebody need to do if they have some questions along the way? Do they need to speak out, or do they need to put it in the chat? What's the best process, would you say?
Yes, so on their screen, they would surely see Q&A or chat option below. So they just need to click on it, type in their questions, So I will read this. I will read the questions to you and answer them real time.
Thank you so much, Zyrel. Okay, perfect. We have Joseph, who will be joining us in just a moment, asking for the link for this webinar. Please send link to Joseph. Okay. All right, here we go. All right, so here we are. So questions that we might be asking ourselves: why are you here today? Burning questions. What's caused you to start thinking about real estate, investing in real estate? Why are you here? By teaching this material to you, I hope to assist you in building your net worth. So I'll just share with me, why am I thinking about real estate? I'm looking for passive income. I'm looking for, once one retires, to have that passive income flowing in to help fund your life, to help fund your retirement, so that your money is working for you. And so we'll cover that. And I think there may be some other people with the same opinion on this webinar this evening. So the question to ask yourself is, how many properties do you own? Is it one, more than five? Okay. Is your goal to grow your personal wealth or to get quick cash by flipping a property? And I think that's a very important thing to talk about right here. When we say investing, there's so many different types of investing, so many different criteria. One investor is not like another. So when you buy for cash, as opposed to cash flow and equity buildup or wealth, buying for cash is basically a way to get quick cash. It's not a way to build wealth, but it is a way to get cash, meaning to find and refer a buyer. That's when you would basically, wholesaling is one way to do it. So you get control of a property by making an offer that the seller accepts, and say you have it under contract for, say, 400,000, and you find another investor who will do some fix up or who will have as it a rental property, you can assign it for, say, 410, 420, whatever that spread is. That's your profit, that's your cash in the deal. Some of the benefits are that you don't have to put, we'll talk more about the benefits and etc. in a moment. So that's one way of being an investor. The other way of buying for cash is when you flip the property. So we recently had a property that received the eventual buyer. They're going to invest some into it. They're going to not flip it, which is an option, but they're going to have as a rental property. But there were people that were coming in with offers, lower offers. Their goal was to flip the property, add value, say put some money into it, add value, new roof, etc., updates, and then sell it to someone else for a spread, a margin, a profit. So those are two ways of buying for cash. Buy for cash flow and equity buildup. You can do a lease option, you can buy and hold, or you can buy, improve, and hold. Those are for long-term appreciation, long-term equity buildup, meaning the rents go up, you're paying down your mortgage, market rates are going up over time. So that's the way you really build wealth on a passive basis, is through option number 2 there, one of those different options. So case study, now we're going to talk a little bit about in Keller Williams, some of the top agents in Keller Williams who, and their journey as investors. So their goal when they first met with Gary Keller, who was the author of this book, also the CEO of Keller Williams, was to quit working in 20 years and to build up $20,000 a month in passive income so that their money is working for them through real estate. Their achievement strategy was to buy 20 single-family rentals, and they're in the Texas market, each generating $1,000 cash flow a month. So the rent, when they receive it, they would pay for the taxes, the insurance, the mortgage payment, the principal, the interest, and still have $1,000 per month left over that the McKissicks could use for themselves. They wanted to complete these purchases in 5 years, and they were going to get a 15-year mortgage. It says 15-year note instead of a 30-year mortgage. And they were going to put at least 20% down. So they had a criteria, they had a strategy, they had a blueprint that they wanted to execute. So in 1991, when they first came up with this idea, they were in debt $600,000 They had a nightclub, and the nightclub wasn't doing too well, so they wanted to get into real estate investing. They made their first investment in 1991. They partnered with their builder. You can see here, located the property. The builder put up all the money. The builder did the repairs, and they flipped it, right? That was strategy number one that we just saw a second ago, to build cash, not wealth, or not cash flow. They went for the cash. They flipped it for a $15,000 profit. Then they invested that profit into another deal. If you fast forward to 2003, 12 years later, they had a net worth, instead of being negative 600,000 in debt, they had a $10 million net worth. They owned 48 single family homes, one fourplex, one duplex, one small complex, one commercial space, and one residential development. And it's only grown in the last 20 years since 2003. So what's covered in this workshop? We're going to talk about the possibilities, think in a million, buy a million, the net worth model, the financial model, network model, lead generation model, netting a million, receiving a million, and putting it all together. So this is, I think, what we've already started to talk about, is that cash flow and wealth are not the same thing. Cash flow is what you're after, and wealth without cash flow won't finance anything. So you could have a net worth of $10 million, but if you're not getting any cash flow out of it, it's not financing some of the things that you want to do in your life. So cash flow and wealth, the combination of the two, is what one is after. And what is financial wealth? It's the unearned income to finance your life mission without having to work. Worth reading that again. So as Gary Keller, the author of this book, says on page 5 of the book, the MREI, meaning Millionaire Real Estate Agent, in terms of creating financial wealth, big money, one of the best ways I've ever seen, one that's truly accessible to anyone, is to invest in real estate. And if you agree, please put in the chat, agreed. If I would do that right now if I had that access to it. This is whenever we have a meeting with the agents, the top agents in the country for Keller Williams, he'll have 10,000 people in the audience. Gary, the author of this book, will say, he'll put up this just to remind us as realtors one more time, and as investors, the difference between the renter and the homeowner, the property owner, in terms of net worth. This is where it's just such an apparent, it tells you. So the average, let's go to 2015, let's say the most recent. The median net worth of a homeowner was $195,400. The median net worth of a renter, on the other hand, was $5,400. So a $190,000 difference in the median of the homeowner versus the renter. So what is the message? Own, 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 own. Message received. And in this book, we talked about the first 125 pages of this book being all about mindset. And he really specifically talks about fear. The people who are non-investors amongst us, there's a fear of investing, right? And here's a great quote, if I can read it to you. Money lives on the other side of fear. I didn't always know this, but I now know it's true. Fear keeps us from getting what we want, especially in matters of money. It's true for me, and it's true for you. All of us can look at our lives and count the times when fear stepped in, preventing us from taking actions and cost us a precious financial opportunity. And that's from page 11 of this book, the MREI, Millionaire Real Estate Agent. I mean, anyone think to yourselves, can you relate to this? I know I've had fear. Actually, I had fear about a month ago when I had a property under contract for a very good price. Fear prevented me from closing on this particular property. I had my reasons for not moving forward, but if you have conversations with different investors out there, there are different things that one can do in a situation. So, for instance, this was, just to give you an idea, this was a property that I had under contract for $400,000, and it wouldn't cash flow with 25% down after principal, interest, taxes, and insurance. Let's say the price would have been about $500,000 if I had done about $30,000 in fix up. So I had it under contract for $400,000, which was a good cost per square foot for the area that we're talking about. I had a long due diligence period of about 21 days, so I could determine if I wanted to move forward or not. And the key here is that you want to give yourself some time, 21 days if possible. And having something under contract is not, that's fine. As long as you're within your due diligence period, it gives you plenty of time to figure out if you want to move forward. There's no reason to have fear. You're determining if you want to move forward or not during that due diligence, that inspection period, that decision-making period, if you will. So my option is just to share with you quickly, where I could close on it. I could then do some fix-up, paint, clean it up, put a renter in there. That was one possibility. But there would have been a cash deficit every month if I had put 25% down. So in the short term, it would have been a cash drain for a few years. However, over the long term, the renter would have been paying down the debt and prices would have gone up, because if I had it under contract for 400 and let's say it was worth 500 after some fix-ups. So one option was I could have bought that property, done some fix up, put a renter in there for 1 year and sold it a year later. That was an option that was available to me. But my point is to you, there's many different ways to do this, but fear is something that, you know, that will be there to prevent us from making deals. So just be aware of that. Sometimes it's good to have the fear. Sometimes it gets in our way. The foundational model of the millionaire real estate investor is the network, criteria, and terms. We talked about the criteria a moment ago. What is your criteria? Are you a flipper? Are you somebody who's going to rent it out long term? Are you a wholesaler who's going to get it under contract for 400 and see if you can find another investor for 420 that will do the work and fix it up and flip it, or someone that will move into it? That's criteria. Then the network are the people that we surround ourselves with that can help us with these deals, whether it's an attorney, an appraiser, a general contractor, a plumber, mortgage, finance, you name it. That's the network. And then there's the terms. How are we buying the property? Are you buying it subject to? Are you buying it with cash? Are you buying it with a more conventional mortgage at say 8% interest? Or are you using a hard money lender at 12% interest, let's say? Those are the terms. So to consider. Then the first thing is, it starts in our mind. Do you believe you can do it, right? Back to that mindset piece for the first 125 pages of the book. Do you think you can do it? Then you start to buy and you start to make offers. And Zyrel can tell you here that every weekend I'm out there personally driving by 4 to 8 properties, looking to see what's out there, seeing which properties I want to make offers on, if not all of them, at the right price, right? So that's when you start to buy. And let's say I've heard an investor that I know, that I respect. He says for every 40 offers he makes, 40, he will acquire 1 property. So it's a numbers game, and you have to face a lot of rejection as an investor. At least that's his approach. Numbers game, right? You make 40 offers at a price that works for you, and he gets 1 accepted. So there's a lesson there. Then you own the assets, and then you start to receive that passive income, that cash flow to finance your life's dream, is what we were talking about. So if there's any questions or ahas, please put those questions into the chat, and Zyrel will read them out to me. All right. So there's 8 myth understandings between you and financial wealth. What are those 8 myth understandings? Here we go. There's 3 personal myths. Myth. Zyrel, would you mind reading? I'll read the myth. Can you read? I'll read the. If you can read the myth, I'll read the facts. Does that work, Zyrel?
Yeah, for sure.
Thanks. Go ahead.
Myth. I don't need to be an investor. My job will take care of my financial wealth.
Thank you for reading that. Truth. Yes, you do need to be an investor. Your job is not your financial wealth. Myth number 2.
Myth. I don't need or want to be financially wealthy. I'm happy with what I have.
Truth. According to Gary Keller, you need to open your eyes. You do need and want to be financially wealthy. It gives you options. It gives you choices when unforeseen circumstances happen, which they all do. They do to all of us. Myth number 3, Zyrel.
It doesn't matter if I want or need it, I just can't do it.
Truth. You cannot predict what you can or can't do until you try. So what are some other myths? What's this 5 investing myths, Zyra?
Myth, investing is complicated.
Truth. Investing is only as complicated as you make it.
Second myth, the best investments require knowledge most people don't have.
And the truth is your best investments will always be in areas you can or already understand. And just a quick example that I've noticed as somebody who lives here in the Miami area as a real estate agent, I'm seeing single family houses out there. Well, I've made, and I sell single family houses. I've made the mistake, in my opinion, of buying an office condo a few years ago, and that wasn't it wasn't an asset class or real estate product that I was familiar with. So one could say that wasn't the best investment to make because it wasn't in my wheelhouse. It wasn't something that I already understand. And if you hear Warren Buffett all the time talking about investments, like I don't understand that business. Therefore, Warren Buffett, one of the richest men in the world, doesn't invest in what he doesn't know. It's the same principle with us. And I know that Zyrel here, she knows lots about land where she lives. So that's an asset class that she understands. She knows the market, if that makes sense.
Yes.
Okay. So what's myth number 3, Zyrel?
Myth number 3, investing is risky. I lose all my money.
Okay. And the truth is that investing, by definition, is not risky. It's speculation that's risky. Investing is not. And how about number 4?
Successful investors are able to time the market.
And the truth is, in successful investing, timing finds you. There's an expression that Gary Keller, the author of this book, The Millionaire Real Estate Investor, likes to say. He says, don't wait to buy real estate. Instead, buy real estate and wait. That's when the timing finds you, if that makes sense. What's number 5 myth, Zyrel?
All the good investments are taken.
Right? Haven't you heard that before? I mean, with all the price rise that we had, especially during COVID in 2021, especially 2022, prices went way up there. And it's natural to think, my gosh, these prices are so high. All the best investments are taken. Well, I just gave you a perfect example of one that I was able to get under contract for 400. And that if I put 30,000 into it, it would have been worth 500,000. That's an example that they're not all taken. It really comes down to situations, motivations of sellers. There's some things that will create good deals besides the economic environment. It's death, divorce, debt. Those are some of the things, the 3 Ds, I think they call them, that contribute to good opportunities if the buyer is there at the right time, where a seller simply wants a solution. They don't want to get top dollar. They want to address their needs to get some get the cash and move on with their life, right? So that's where you can get some good deals. The myth, again, is that every market has its share of good investments. That's the truth. Okay. So the key thing here, before you even go into investing, is discovering your big why. So the question here is, why do you want to invest in real estate? And if you let's just take a minute or two here to go through this exercise before we resume and just answer these questions for ourselves. So I'm going to put it on for 90 seconds, the timer, so we can ask you, why do you answer these questions for yourself on a piece of paper? Okay, 20 more seconds. All right, 10 more seconds. So anyone who went through that exercise, feel free to, how would you recommend they share if they wanted to, Zyrel? How would they share their answers if they were feeling bold?
Yeah, so they can just click on chat or type in there the questions that they have or raise their hand if they want to, share, and we can allow them to talk.
Sounds great. Thanks, Zyrel. Okay, so if anyone wants to share, please, let's get 5 seconds for you to say if you want to share what your answers were to share with our group. And by sharing it with the group, it becomes more real for you because you're putting it out there into the world, what your intentions are. So there is a benefit to sharing and being uncomfortable with, what you wrote down there and sharing it with the group. Okay, so I'll go. Why do you want to invest in real estate? I wrote down passive income, control my destiny, work because I want to, not because I have to, comfortable retirement. And then why is that important to you? Do what I want with my time. And why is that important to you? Live life on my terms. And ultimately, what does that mean to you? I wrote down in capital letters, freedom, right? So that's mine. And it's worth really digging into what your big why is, because that will propel you to take action. What's at stake here if you connect the investing to your big why? Any questions or comments, please, just put them in the chat and Zyrel will read them to us. So how do millionaires think? Big goals, the specific measurable targets that fulfill your big why, which we just talked about. They have big models, which are the proven systems and strategies for reaching your big goals. And then there's the big habits, the consistent actions and right choices that come from following these big models. So here's an example of big goals and big models and big habits. And you'll notice that there's big models and big habits that build wealth on the top of that horizontal line. And there's also big goals, big models, and big habits that get us into debt below that horizontal line of time. Interesting, right? So you can see here the net worth, 5,000 models and habits. There's $175,000 models and habits, and there's $1 million models and habits, right? There are different habits and different models that these different net worth holders are following to achieve, because success leaves clues, right? Results are different based on different models and different habits that the individuals were following. By the same token, you can see the same thing here. Somebody who was in debt 5,000 had the habits and the models of someone who is 5,000 in debt, versus someone down below here, all the way to $1 million models and habits in debt. So the key is for us to have goals, models, and habits that will lead to an increased net worth rather than debt. That's the idea. So the power of leverage in the money matrix. So here it talks about having your money work for you in the blue section on the top of the top pyramid right there. Financial wealth that's built on capital and cash flow. That's what the millionaire real estate investor strives for. It starts with the capital. Capital might come from your paycheck. That can go into cash flow by buying assets like real estate where people are paying rent for this asset that you own, renters. That's going to give you cash. Then the last thing they're thinking are these people that are in the investment path is consumption. Fancy car, fancy purse, travel, restaurants. So yes, those are fine, but those need to come after deploying your capital through assets like real estate that create cash flow, and then think about consumption. But what do most of us Americans and people perhaps around the world, what is the most common way to do it? It's first, when one gets one paycheck flow and capital last. Where basically the model below is where you are working for money right there, the lower pyramid. And what we want to be in, we want to strive to having money work for us. And there's this great Adrian Sabatino. He's a great agent and an investor in the Naples, Florida area. I went to one of his classes a few weeks ago, and he puts it like this. He has every dollar that he has, he wants to measure and make sure that it's performing well, like an employee that's a very productive. So what his analogy is, imagine a break room in some office setting. There's the company break room, and you see a bunch of employees sleeping there, sleeping on the floor. In his opinion, that is representative of money that's in the bank in a checking account. It's not doing any work. It's not producing. So he wants his money, each dollar, to be accountable to getting a return, as opposed to be sleeping in the break room, which is what it's doing when it's in a checking account. I thought that was a really good way to phrase it, right? So basically, Gary Keller from Texas, he says here, big at, no cattle. Shadow wealth is built on consumption and cash, shadow wealth. So something to keep in mind. Where do we want to be? Do we want to be in the top, or do we want to be in the bottom triangle? Do you want money to work for you, like Adrian Sabatino, or do you want to work for your money? And basically, just a bit more about Adrian, because I really respect him as an investor. His goal is to get to the point where he can finance his monthly expenses for his family with, right now, he's at about 10%. So basically, his monthly expenses are 10% of his cash flow that he gets from his multiple properties. His goal is to bring it down to 1%, so that 1% of his expenses per month that can be paid for by the money that he gets on his investment properties. So it's a great goal. He's operating clearly in the blue triangle right over here. Something for us to think about. And that's, again, one of the reasons for this is to change the way we think about things. Mindset, first 125 pages of this book, Millionaire Real Estate Agent, it's about mindset. I just given you another example of mindset. Capital. So what is capital? It's money invested in anything expected to grow in value. What's cash flow? Money generated from those investments. In this case, real estate. And what's cash? Money held in reserve for security or future investments. Lots of time we get cash from paychecks in our job, right? Consumption, money spent on anything that's not expected to grow in value. Zarel, can you give me some examples of consumption, things that are not expected to grow in value? Or anyone out there?
I'd say groceries,
Perfect. A great example. Grows exactly that consumption. We need it, but as long as we realize that it's not something that will grow in value. So learn how to track your net worth. This is one thing that Gary learned over when he was building the biggest real estate company in the world, Keller Williams. And when he wanted to increase his net worth, he would meet with a friend of his named Michael. They'd have breakfast once a week. And Michael said, Michael was a money manager, very knowledgeable about investing. And he said, Gary, the first thing you need to do is you need to track your net worth. I'm not going to have these meetings with you, these mentor meetings on building your net worth, if we don't track your net worth. And you need to bring it to me every week, because what you focus on expands. Once you're looking at your net worth, at least on a monthly basis, if not a weekly basis. I've chosen to do it on a monthly basis myself. And so basically, how do you calculate your net worth? What do you own? Let's say you have a house, a car, whatever it might be. And here's an example. Home, what you own. And then if you owe on these different items, 223,000 between those three items, then your net worth, you just subtract, your net worth would be 3,000 in that scenario. Make sense? So have on the wall or somewhere, have your net worth that you can. And what's amazing when you start to do this and you do it monthly, you start to see, oh, wow, certain decisions that you made, or maybe you didn't make any decisions, just the market, whether it's real estate or stocks, it affected it and it went up or down. And you can just see over months, like over 2-3 years now, I've noticed the different variations and how it can really be affected by your decisions and the market. So there's unique propositions of investing in real estate in contrast to stocks, mutual funds, and money markets. So the question here is, why real estate with your money, your capital? Why not buy stocks? Why not buy mutual funds? So here we'll get into that, the advantages of real estate. It's an able investment. Its value never goes to zero, and you can leverage your purchase by putting a down payment and getting a mortgage. It's usually called leverage. So why do they call it able? Could you read 1 through 4, Zyro?
Yes. Accessible, anyone can buy it. Appreciable, increases in value over time. Rentable, cash flow, cash flow, cash flow. Improvable, sweat equity.
Thank you. And that number 3, making money while you're sleeping. That's the beauty of it. You're sleeping and you're making money as people are paying your rent. Undeniable. Deductible, it's depreciable, it's deferrable. So you've got great tax benefits. Number 5, it's stable, it's slow to rise and slow to fall most of the time, and livable, shelter in more ways than one. So what are the tax write-offs? Operating expenses, management, leasing, mortgage interest, financing costs, miscellaneous closing costs, depreciation on the structural value of the property, capital improvements, new roofing, etc., personal property, the furniture, the lawnmower, and maintenance expenses. So if you consult with your CPA, he or she can really help you get tax write-offs so that you lower your tax bill when you have to pay taxes because you own real estate. So here's a great example that we talked about earlier, why investment properties versus other asset classes. So let's say you have $100,000 in cash to work with. So if you buy stocks, you buy 100,000 in stocks. Mutual funds, you buy 100,000 in mutual funds. Money market, 100,000 in money market. Investment property, you wouldn't have to buy it all cash with 100,000. You could put 20% or $20,000 down as the down payment and get a mortgage for 80%. So let's see what that looks like in terms of the carrying costs, 1 to 4% for each. Other costs in investment properties, you are going to have a 10% vacancy or maintenance. Let's calculate that in there. So that's the cost that you would not have with other asset classes. Your income per year for the stocks is say 8% historically, mutual funds 10%, money market 2%. Well, right now it's probably closer to 5%, depending on which money market you get into, because the treasury bills are high. Investment property, 5% appreciation over nationally over the last 50 years. It's 4 to 5%. Maybe Miami's a little bit higher because it's a very, very hot market that people are descending upon from all over the world and all over the country. So if you were to look here at the adjusted return on investment, it's 4 to 7% for stocks, 6 to 9% for mutual funds, 2% for the money market, but 25% for investment property. Why is that? Because you use leverage and you didn't put all $100,000 into the purchase. You only put $20,000. And here's how they explain it right here at the bottom. So why is it 25% return on investment? It's because if you put 5% of the 100,000, so it went up 5% from the time you purchased it to 1 year later, because we see here 5% appreciation. 5% of 100,000 recalculated for the actual 20,000 investment is actually a 25% return because you only put $20,000. So you get a 25% return, which is very healthy money according to the book MREI. You want to get your money, healthy money, as Adrian Sabatino says, money that's working for you and really working as a hard employee, that's in the 12, 13% plus range. So here you're clearly seeing how that can be done with investment property if you're putting 20% down, let's say, because of leverage. Potential loss, let's take a look at that. You can lose everything in stocks. as I did with one time with Sharper Image. That was a stock that was on there. Mutual, it was back in the day, about 20 years ago. I think United Airlines back in the day, they went to zero for a while. Now they've reemerged. But bankruptcy, you can lose your money in stocks. Mutual funds, you can lose it all. Money market, not so much. Investment property, you can lose about 40%. And we did see that in Miami in 2008, but you didn't lose 100%. So, and of course, it went up since then. It came back. There you have it, a little. So what is leverage? It's using other people's money, banks, mortgage companies, owner financiers, to make money, as we just discussed. Leverage is what multiplies your profit. Appreciation and rent are based on the total value of the property. So return on investment is calculated by your money invested, not the price of the asset. So as we said earlier, here you can see how they did that calculation. If your $100,000 house went up 5%, which is 5,000. 5,000 is what percent of 20,000 that you put in? It's 25%. That's how they came up with that figure of 25%. So to make the same money in a mutual fund yielding 10% with no cost, you would need to have $250,000 cash, right? A lot of people don't have that, but we do have $20,000 that we can work with. Any questions in the chat so far?
None so far, Jason. None so far, yeah.
Got it. So here we are in so there's 5 models. There's the net worth model that we've touched on, learning the path of money, budgeting for your investments, making investments, and tracking your net worth. We talked about that. Then there's the financial model, which is understanding the triple benefits of real estate: cash flow, appreciation, and debt pay down. And I'll tell you, it's magical. We'll go into that in a second. And I've experienced it myself as an investor. Network model, we talked about a bit about that, networking for knowledge, leverage, and leads, and then building your investment dream team, the people around you that can help you. So what's lead generation model? That's establishing your criteria, prospecting and marketing for real estate investment opportunities that you know that are in your wheelhouse, that you understand. For instance, Zyrel, we talked about land where she lives, or me, single family houses where I live, not office buildings, right? Not office condos for me. That would not be my criteria. Master terms for making offers, which is the acquisition model. How are you going to make the offer so that sellers would accept your offers? Is it going to be, are you going to buy and hold? Is that what you're looking to do? Or are you going to buy and sell, flipping? Things to know about yourself, your skill set, what you want to achieve. Okay. So this could be one of the most important. If you have a chance to take a picture of this screen and print it out and put it somewhere, this is probably one of the most important models there is in the entire book. And this is the whole piece of human capital, where you work for money on the left, or capital assets, where your money is working for you. Question: where do we want to be? We want to use the money from our human capital, which is our paychecks, commission checks, whatever it might be, and deploy it into capital assets where the money is working for us. Cash flow. So what can you do with your commission, let's say, or your paycheck? You can spend it, you can donate it, you can hold it, or you can invest it. And the idea is to put your percentage down that you want to earmark for each of these 4 choices. So when you invest it, there's 2 basic investment choices. You can lend it, or you can lend the money, or you can own in your investments. So for the passive investments, there's money markets, CDs, bonds, treasury bills, which are paying pretty well right now, about 5.5% at this point in time. Then there's stocks that you can own, real estate investment trusts, mutual funds. So what's the key message here? They control it. You have no control over it. That's why they call it passive. Now, if you're in the active investment, you can lend and you can own. You can do owner financing, which one of my sellers right now for a gorgeous condo, 50 Biscayne, number 5204. Beautiful 2-bedroom condo overlooking the cruise ships going out to sea here in Miami. $1 million view for sure. They're offering owner financing, which is a great opportunity for the right buyer. And they're making a little bit of interest as well. That's an example. or you can do private lending. There are lenders out there that will do private lending, hard money lenders, to someone who's looking to flip a property within, say, 3 to 6 months. These hard money lenders, these private lenders, will make above average returns. So instead of 8% that you could get from a big bank right now, they might charge 12, 13% to lend the money for 3 to 6 months to the investor who's looking to flip. Then what you can own businesses, you can own real estate is what we're talking about. The key here is that you control it as opposed to having someone else control it. Then you're going to get your financial returns here at the bottom, and then number 5, and you come right back up, and your choice is to put it back into capital assets and start the whole process over, cash flow, and it just like a snowball gets bigger and bigger with net worth over time if you follow that path, as opposed to focusing on consumption first. Does that make sense? All right. So that's a very important slide there. If you have a chance to really take a picture of it, print it out, make sure that it's visible so you're always reminded of this key path, the path of money. So understanding the language of real estate, the real estate sales cycle. So basically it goes 10 to 15 years, you'll have a boom, 2 to 5, bust, boom, bust, boom. But what's the key? The key is that over time, you have a price floor that it doesn't go back below, and it continues to go up and up over time as you get peak prices and you have inflation. And that's when investment properties in an inflationary environment, really, that's when it's a great hedge against inflation, because rent goes up, you benefit as the landlord. The price of the real estate goes up because of inflation, you benefit as the landlord, if you see what I mean. And the beauty is that you're locking in the mortgage rate for 30 years, let's say, and you can refinance if rates go down. So here's an ROI, return on investment calculation. Let's go through this for a second. Purchase price is $100,000, down payment $20,000, rehab cost $10,000, interest rate is 5%. Rental income, you get $14,400. Mortgage is $51,53. Property taxes are $2,000 a year. Insurance $500. Your management fee is $1,400. Maintenance reserve $720. Vacancy rate $720. So after paying all those items, your cash that you get from the rent on this investment property is $39.07, which is a 13% return on investment. So basically $39.07 divided by, let's see here. Yeah, 3907 is your cash flow after all the paying all those things we mentioned here, divided by your down payment of 20 plus the rehab cost of 10, which is so 3907 divided by 30,000 brings you 13% is what you see. Not too shabby. That again, that's healthy money that is working hard for you, that you're holding accountable to perform, as opposed to just sit there in a checking account in the break room snoozing, right? Important for us to get that visual, that image. So what understanding the language of real estate. Challenges. What are the challenges in today's investor market? Investment properties are harder to find. Yep. Interest rates are increasing. We've definitely seen that. It's gone from, say, 3% to 8% in the last 2 years. Fewer available distressed properties for sure. In 2008, 33% of our MLS in Miami was foreclosures. Another 33% of the available properties in MLS was pre-foreclosures, and only 33% of the properties out there where the owner wasn't underwater, meaning that the value of the house was worth more than what they owed on it. It was incredible. That's not the case today. What are the advantages in today's market? Fewer investors are in the market. Absolutely, because especially the institutional investors are shying away from the 8% interest rates, right? Interest rates are low compared to the past, right? So here's a perspective. Over the last 50 years, what would you guess the average interest rate has been? 50 years. It's about 7.25%. About where we are now, not too far away from where we are. That's been the average. So for any of us that are thinking, oh my gosh, interest rates are so high, they were 2.75, now they're 8. That's been the average for the last 50 years. something to consider. So rents are rapidly increasing, which is definitely a reason to be an owner. Don't wait to buy real estate. Buy real estate and wait while these rents are increasing. And there's a high demand for rentals. I drove by the properties that I was looking at, the potential investments this past weekend. And I saw a 2-bedroom, and I called the realtor because you want to know what things are renting for. That's a key piece of this buy and hold income approach. You want to know how much are 2 bedrooms and 3 bedrooms, let's say, renting for in an area. So when I was called, and I'm a realtor, I'm in the business, I was surprised. I was expecting maybe 22, 2,300. She said, no, they're asking 2,700 for this 2-bedroom. Just goes to show interest rates, sorry, rental rates, demand are going up. So avoid the pitfalls of investing. So what do they mean by that? I said earlier, invest, don't speculate. Zyrel, can you read collector and investor on the top and the left? And and I'll read the speculator observer.
Yes. Investor, minimum risk, maximum return. Collector, low risk, low return.
Perfect. So some examples of collectors, low risk, low return. Anything come to mind as far as what's a collector with low risk, low return? Stamp collecting comes to mind, right? It's low risk, but you're not necessarily going to make a killing on the stamps if you don't necessarily know what you're doing. That's an example. Speculator then is high risk, high return. And there are some products out there that we all know that there's high risk. You could lose a lot of money, but you could also make a home run. That's speculation. It might not have been through knowledge, but speculation. And you do see that in real estate as well. We saw that in 2006, 2005, during the condo boom that we had at that time. You'd see 20 to 25 cranes at the same time in downtown Miami, building new buildings all at the same time, condo boom. Those were speculation driven at that point. You had people that would buy something, a tower is going up, somebody buys from the developer, pre-construction they called it, and you get a very good deal. Say you buy it for 300,000. And then before the building is completed, this initial investor in this boom, they hand it off, they sell it to another investor and they make a profit. So they bought it for 300, they might sell it to the next investor for 375. The building's not even finished yet. They haven't closed on it. And then that second investor who bought it for 375 might sell it to a third investor because they still speculate that it will continue to rise once the building is finished. And they might buy it for 500,000 from the second investor. So that was speculator. And a lot of those speculators got burned in 2008 when the market came down because it was high risk. Even though you can get high return, it was high risk then when the market came down. That was not investing. That was speculation. Then there's the other one, the observer. What's the risk of the observer? There's no risk. What's the return? There's no return either, right? So where do we really want to be? We want to be at the top here. Investor. Minimum risk, maximum return. So avoid the pitfalls. What are the pitfalls? Common investor mistakes are didn't run their numbers. Speculation. They didn't run their numbers. So what we just talked about, not running your numbers. Insufficient reserves to handle if you have a few months of vacancy, let's say, or all of a sudden, I need a new roof. This one is 20 years old. I've got to get a new roof. These things do happen. So having some reserves is important when you're making an investment. And unsure how to calculate the return on investment. There's a really good program. There's two resources for you. One is calculator.net. Calculator.net that helps you if you're flipping or if you're a buy and hold investor that wants to rent out properties. That's a great resource, calculator.net. And one that I've been using, there is a chart, and that one's free. One that I've been using is biggerpockets.com, biggerpockets.com. It's an investment community. And they have a mortgage, they have a calculator there for people who are looking to buy properties and hold on to them and rent them out. So my goal is to get to 1,000, to run the numbers on 1,000 different properties so that I can gain mastery of running the numbers. because that's one of the opportunities for me is to improve and running the numbers and calculating that ROI and comparing the ROI before deploying the capital and buying the property, if that makes sense. Really want to become a master of calculating that ROI and comparing different properties that I see out there every weekend. Confirm your investment criteria. So if you don't own a home and you've got little or no money to invest, the solution there, what you want to strive for is to buy there and live in it. If you have some money to invest and you're looking for cash, you can buy and then sell it. You can flip it. And if you have money to invest and you're looking to build wealth, that's a different story. You're not going to buy and sell. You're not going to flip. You're going to buy and hold. And we'll talk about that in a second, how that works. Okay. So now let's talk about partnership pros. What are the benefits of partnerships? I've been in some partnerships myself, and I've experienced some results from those, good and bad. But let's see what it says here. It can reduce your risk because you're not putting all your money in. You can make up for what you're lacking, larger down payments, strong financial statements, and partners may have experience, time, or expertise to lend outside of finances. What are the cons? Since you share in the cost, you must also share in the success. You can lose control of the business based on decision-making strategies for the partnerships, and a partner may buy you out. So partnerships dues. Find out about your prospective partners and be comfortable with their reputations and capabilities. Number one. Number two, write a business plan that includes your goals, your priorities, and strategies to make sure that both partners have the same vision, ideas, and direction. Start with an operating agreement from an attorney that outlines each partner's responsibilities, the goals of the partnership, and builds in as many contingencies as possible. And start with a small deal as a test run. If it makes money, everyone does what is expected, take it to the next level. In other words, date first, see if you get along before you marry. So in partnerships, I've had three partnerships that we did quite well. Things were great. Then we moved on to the next project, or we didn't, depending on the situation. One mistake that I made, we bought a 10-unit building in Louisville, Kentucky back in 2005, myself and two other partners. I was newer as an investor, and the mistake I made, and make sure you don't make the same mistake, we didn't have an operating agreement written out by an attorney that outlined each partner's responsibilities, the goals, and the contingencies. What if one partner wants out and the others don't? What is the operating agreement is about the exit strategy. How do you exit? That has to be established up front. So super important, the operating agreement, because it makes you put your exit strategy in place and determine what you want out of the strategy, the vision for the property. Case in point, in my situation, just to share, it was a beautiful 10-unit Victorian home, 4 stories, near the University of Louisville, and on 3/4 of an acre. A trophy property, really was a beautiful property. I wanted to keep it as is because it had been chopped up into 10 rental units for university students, professors, etc. And then another partner wanted to convert it to 3 luxury large units, 1, 2, 3. Either one is fine, but different investors had different visions for this property. One requires a lot more capital to make those improvements, to convert it to condominium where you can sell these 3 units out. So good to know that if you've got an operating agreement, you know that going in. That's very important. So partnership dues, so we talked about that. Partnership don'ts. Don't overcommit. Don't underdeliver. Don't do it just for the money. Do it because you have a common vision for the neighborhood, for the property. It cannot work if you and your partner's visions are not aligned. I just showed you in Louisville where things can go wrong. Don't move forward until everything is in writing. Small disagreements can lead to big problems. Don't move forward till you consult your tax advisor and your attorney. Very important. We talked about that. So here is the magic of real estate. So you buy a property, you've got your debt, let's say your 80% mortgage, which is in the red. You've got your investment, which is your down payment of $20,000, let's say. And then you've got the equity. So price appreciation minus your debt pay down is the equity buildup. And that's where just time, don't wait to buy real estate and wait, That's where this equity buildup just magically happens over time. Your debt is going to go down. Why? Because your tenant is paying the mortgage each month. Your investment is not going to change because you put your 20%, for instance, down when you bought the property. And then your equity is going to go up. Why is it going to go up? Because your debt is being paid down and the value of the property with inflation over time is going up. So price appreciation plus debt pay down equals equity buildup. At some point, your debt will be paid off. You will no longer have the red. It'll be just your initial investment and just equity because your tenant paid down the debt, or you paid down the debt if you're living in the property. So buy it right, pay it down, pay it off is the model here. So rent appreciation plus debt payoff equals cash flow growth. So this last one was price appreciation, debt pay down, like say if you live in it, right? This would be the model if you live in it. Now, if you are renting it out, you're the landlord, rent appreciation plus debt payoff equals cash flow growth. Your vacancy and expenses in red will remain the same. It's about 5 to 10%. Your debt service is your monthly mortgage payment, and your cash flow is what you get after paying the debt service and the vacancy expenses and that type of thing. So vacancy and expenses remain a constant, say 10% between the two. Debt service remains a constant, but cash flow is going up. Why is that? Cash flow is going up because the rental amount over time is going up. Your rent is increasing every year, 2 years, 3 years. Until such time that your debt service, your tenants have paid off your mortgage and you no longer have the gray debt service. All you have is cash flow, lots of cash flow coming in. Okay. So why do people invest in real estate? We talked about less out of pocket, 20% versus 100%, tax write-offs. You're growing your net worth through equity. As you sleep, your net worth is growing up through equity. There's no better method of investing your money. Absolutely. We talked about the network model. So what is a network model? Who are the people that you want in your inner circle, your outer circle? So here's you in the middle, the millionaire real estate investor. So you've got your consultants, your partners, your mentors, your inner tribe, if you will. That's your inner circle. Then right outside of that are other investors that you can bring in, accountants, contractors. It's called your support circle. Property managers. I'm just hiring a property manager right now in my support circle so that I don't have to manage it anymore. That allows you to really focus on finding more deals, right? Gary Keller says in this book, he says that too many investors wait too long before they hire the property manager. Something to be aware of. So they're managing property, all the things that you need to do, instead of focusing on where the next deal is. You want to put yourself in the position of making offers, finding deals. Attorneys are part of the inner circle for sure. Lenders, real estate agents, right here. Would love to apply for the job if you're looking for one. Now, then where's the outside, the service circle? Very important. Plumbers. I've got one that I've used for 20 years now. Roofers, very important, someone you trust. Concrete company, insurance agencies. I can give you lots of these if you call me, text me at 786-326-8115. Be happy to share with you some of my resources from my service and support circle. Developers, landscapers, appraisers, inspectors, builders, appliance rentals, lawn service. It's important to not be looking for these, to have them already in place is the idea when you're buying properties, okay, and upgrading them. So ask your network, what type of property are you currently renting? What are you getting for a typical 3-bedroom home? Important to know those rents. How long are the homes in the area on the market? Vacancy factor. Are rents going up or down? In Miami, they've been going up. If you're asking, how many single family homes do you manage? That's what I just asked my property manager that I'm hiring. How many multifamily? And so she showed me. It was a very good exercise. So yeah, these are some good things to know when you're asking your network. So the lead generation model. So what kind of criteria? What is your criteria? There's so many different things you can do. Are you looking for single family? Are you a condo investor? Are you a townhome investor? Are you own mobile home parks? Are you looking for duplexes, fourplexes? Are you into land? Right? What is your wheelhouse? What is your real focus? Jack of all trades, master of none, right? So you don't want to be doing all of these things. The idea is to have a niche. In the niches are the riches, is the expression. So really get good at it, knowing, like, for instance, school district. You just like this school district because you know there's a high demand. Transportation. You just focus on areas where there's great transportation. You know, all kinds of things to consider. And then you can, I mean, further criteria is what year was it built? Are you looking for old Spanish? Are you looking for Miami modern? Are you looking for 50s homes? Are you looking for brand new construction? Are you looking for small homes, big homes, wooden homes, concrete homes? So much. Duplex zoned lots. You get the picture. So who can help me find it? Owners. So for sale by owners, you can go to MLS listings, expired. These are builders, developers. They're all great ways to identify people who connect you to properties that meet your criteria. Bank officers. I know a gentleman named Nick. He's got some great relationships with people inside banks that give him access to their properties that are not performing. There are non-performing assets in the bank. They want to get it off their books. He's able to buy these properties at very good deals from these bank officers because of those relationships. We talked about death, divorce, debt. The attorneys are a great source of motivated sellers, from bankruptcy attorneys, probate attorneys, eviction attorneys, divorce attorneys. Great relationships if you want to find properties with motivated sellers. Leads network, you can have core advocates, allied resources like mortgage brokers, accountants, property managers, etc. That gives you a picture, an idea. So how will I find the property or people connected to it? You can use the phone to call for sale by owner sellers or people in a certain area. You can door knock, you can meet them face to face, you can go to homeowners association meetings and ask around. You can drive an area. If you see some tall grass, or if you see a house that's not well maintained, leave your card, maybe leave an offer there, because that could be someone who's having some difficulty paying the monthly expenses, and maybe they would welcome an offer from you. Investment clubs. They have the Dade County DREA, Dade Real Estate Investor Association is an example, or BREA in Broward. Courthouse proceedings, probate, foreclosures, bankruptcy, evictions, divorce. Marketing, you can do business cards, you can do targeted letters, you can do direct mail, internet, flyers, you name it, newspaper ads. You've seen the billboards, right? You've seen magazine ads, signs, all kinds of ways to find out motivated sellers. Which properties are the real opportunities? This is another one. You want to qualify all suspects and focus only on the prospects. Separate the suspects from the prospect. The real ones that are motivated, that will sell for a price. They want to sell as soon as possible. That's what you're shooting for. Okay, so we talked again, criteria, terms, network. Choosing a strategy, understand value and get perspective. Again, you can buy and live if you don't have too much money. Buy and sell if you want to get more cash. Buying and selling, again, is not about wealth accumulation. It's about getting money, getting cash. Buying and holding, don't buy real estate. Buy real estate. Don't wait to buy real estate. Instead, buy real estate and wait is number 3 here. That's when you have money and you want to grow your net worth. Any questions or comments, please put them in the chat, and Zyrel will go ahead and she will read those out loud. We talked about the path of money already. Very important, this model. So let's go into the different types of properties that you have. You've got the condominiums. From a lending perspective, these are all considered residential. There's condo, single family, duplex with 2 units, and fourplex with 4 units, for example. What are the pros of the condominium? Zyrel, could you read the pros of owning or investing in condos, please? Okay, I will go ahead. Lower purchase price than a home in your area, the pros. Maintenance is included, so you don't have to shell out additional money for a new roof, let's say. And there's more amenities, pools, gyms, valet, that type of thing. What are the cons of a condominium? High HOA fees is something that we often hear. Less cash flow if you're renting it out. And you only own a percentage of the land. So you can't tear down the condo and build something else there because you don't own the land. You own a percentage of it. And typically there's less appreciation with a condo than there would be for a single family home. So what are the pros and cons of a single family house? Easiest to resell. They're typically surrounded by owner occupants, and there's more appreciation in a single family. What are the cons? You've only got one unit to generate income, and when it's vacant, you're getting 100% loss for that month or those months. So what are the pros of a duplex? Typically, they're close to or in single family neighborhoods. There's less risk than a fourplex and more cash flow than single family houses. So what are the cons? Lower appreciation than a house, and usually surrounded by many other rental units, which is one of the reasons why there's lower appreciation. Fourplex. What are the pros of a fourplex? They generate high cash flow. You got 4 people paying your rent each month. It minimizes the financial impact. What does that mean? Say you have one tenant that moves out, you still have 3 tenants that are paying you that month their maintenance fee, their rent. And there's economies of scale. What does that mean? Say you need a new roof. If you had 4 different rental houses, at some point you have to buy 4 different roofs. Here, with a fourplex, you just have to buy one roof, which is less expensive than buying 4 single family roofs. What are the cons? There's more upkeep. There's tenant damage when you have 4 units, less appreciation than a house. And at 4 units, you can start to have some tenant conflicts, different personalities not getting along. Something to consider. All the more reason, in my opinion, to hire a property manager to take that off your hands. And this talks about millionaire real estate investors thinking in units. Each management unit represents time, focus, cost, and liability. They also each represents a cash flow stream. So you want to, as time goes on, you want to maximize your cash flow and minimize management. And this basically just talks about getting to larger multifamily and commercial over time, starting out with single family. And at some point, as you get more and more money, you're getting to larger multifamily and commercial is the idea behind this slide. The key message from this one is that you want to try to get at 80 cents on the dollar. Try to see if you can, by making lots of offers and really researching the market, you've made a good purchase when you can buy it at 80% of the market value. And it's going to give you about 5% annual appreciation, regardless of where you buy, typically, at least here in Miami. There's something called the 1% rule. If you can find a property, let's say if you can find a property that rents out for 1% of the purchase price. So let's say it's a $300,000 house. If you can find a property that could rent for 1% of that 300,000, meaning $3,000, that meets the 1% rule. Not easy to do. If I were to look at 15 properties, I'll probably find one of them or 2 on the MLS that meets the 1% rule. But you will, in a metropolitan such as Miami or Orlando or other places, you'll find ones that are slightly less than 1%, 0.8% of value. You'll see those out there. So you don't want to buy a property. You don't want to buy a rental property that has 0.5%, meaning what? They're asking $300,000 to purchase it, but it rents out for only $1,500 a month. That would be 0.5% of the value. That wouldn't necessarily be a good investment. You want to look for the rental properties that could potentially meet that 1% rule. It's not a guarantee that it's a great investment, but it's a really good indicator that it's worth looking into further, because it's a great rule of thumb that allows you to sort through lots of properties quickly with that 1% rule. And then they're recommending here a 30-year loan as opposed to the McKissicks who did a 15-year loan. But a 30-year to me is easiest. It's the easiest to manage and have it cash flow with a 30-year as opposed to a 15-year mortgage, because that's a higher payment on the 15-year. Okay, so maximizing your NOI, increase your gross rental income. That you want to make sure that you're always keeping up with the market as the landlord. Control your expenses and minimize vacancies. That'll maximize your NOI, net operating income. How do you maximize your rents? You in your contract, you can put a contractual rent escalators. I've seen many investors who don't do this, and so they're just so happy to have a tenant in there who's paying and taking good care of the house, but the tenant is paying half of what the market rate might be. I'm a perfect example myself, which is why I'm going to a property management company so they can have those hard conversations to get the rent to the market rates, because they don't necessarily have that relationship with the tenant, and they realize that it's a business, or find another tenant. So it's something to consider. Strategic improvements, maybe you could put in some things that would add value to the property. Think for yourself what might do that. Government subsidies, Section 8 comes to mind. You can have the government will pay a large portion of the tenant's rent. And I have a property that Section 8, I really enjoy being a Section 8 landlord. It's a win-win. The tenant wins, the landlord wins, the tenant takes good care of the property. Non-refundable deposits and fees, lawn service, cleaning services. You can have some coin-operated laundry facilities, different profit centers you can have. No value. How do you know value? Because you've got that criteria that we talked about. You don't even have to look at the MLS or the internet to know that it's a good value, right? You know, because this is what you focus on. Zyrel, again, she knows lots, she knows lands in her neighborhood. She wouldn't necessarily, she knows a good value when she sees it. Same with me with a single family house. Find the opportunity. We talked about big habits, big models, right? Finding the opportunity requires the habits on a consistent basis, putting it in your calendar. For me, it's the weekend where I'm looking for properties for myself to make offers on. Make deals means make offers, right? I told you earlier that you have to make some lots of deals. Okay, so let's hear. Well, that's lots of offers to get the deals. What's the next thing right here? In the beginning, of course, you're going to be a novice. You're in the game. At some point, you become an expert with time on task. The goal is to gain mastery, and that will suit you well in terms of your net worth, getting through the learning curve. Proven systems, 30-year or 15-year, 20% down or more. Okay, questions? Okay, this talks about compounded growth. Just if you bought $100,000 investment property each year by putting 10,000 down and achieve a 5% return, you'll be a millionaire in less than 10 years. Okay, this shows different ways to get to that $1 million in passive income based on different gross earned income, different investments, different ROIs. So with that healthy money here of say 10, 12 and a half, 15% that you get in real estate, you basically, if you invest $15.3 million, that would get you $1 million in passive income, versus at 2.5%, you'd have to have $61 million in real estate. Okay, wealth accumulation. So in the beginning, work to learn, then you work to earn, protect what you've earned, and then you share what you've earned. Okay, and then here we are at the conclusion. What are the steps to take? A financial track. Step 1, establish a base camp. Create your personal budget. Avoid debt. Save 3 to 6 months of living expenses as your emergency fund in staggered CDs. CDs are paying healthy money right now, 5% and above. Purchase protection, maximum disability protection, life insurance, best health insurance. Purchase your home and try to pay it off as soon as you can. Step 2, fund the future. Okay, set up a 401k, an IRA, mutual funds, real estate investment trust, invest in businesses, real estate, a children's college fund, protect the future, see an attorney, make your will, Form a family partnership. Partition the income between the husband and wife and possibly your children. Put cash needed to live in a checking account. Put the remaining cash in family partnership and push down into LLCs. So that's where we're studying a little bit more. Create appropriate trusts and wills that fit your age, your goals. The future is now. Continue investing in your portfolio, purchase your dream home and your vacation home, and then begin gifting to your children. That's later on, donating to charities. So it's going to require energy, all of this, right? So there's not meditate, but meditate and pray for spiritual energy each morning. Exercise and eat for physical energy. Hug, kiss, and laugh for emotional energy. Plan and calendar for mental energy. Review your budget and net worth sheet for investment energy. Finally, lead, generate, and see real estate for wealth building energy. And there's 6 truths about money. I'd have Zyrel read but I know it's kind of noisy where she is right now. Truth number 1, the key to happiness is not more money. Happiness is happiness, money is money. Number 2, whatever your life is about, more money will amplify it. Money won't change you, it will expose you. Number 3, lifestyle is style over amount. And style is an art. Your personal art of living. You cannot buy style with money. You cannot buy good taste or good decisions with money, but you can only buy more with more money. The life quest is to have the best life in the time available to us. It's not the amount, it's the value. Money does not buy value as it pertains to the best life possible. Money will come to you when you are doing the right things that we've just talked about. Money has its own rules, its disciplines. If you don't learn them, you are basically financially illiterate. We talked about putting it all together, the big why, big goals, become an investor, build your network, define your criteria, work your database, get your leads, engage your network, make offers. It's so critical to make offers on a regular basis. Make offers, make offers, make offers. It doesn't matter when you get it under contract, you've got this decision-making period of 7 days, 21 days, the longer the better for you. But there's no risk in getting something under contract. You can, as long as you see if you want to proceed, and before the end of the inspection period, the decision period, exit if you don't want to. There's no risk to you from doing that. Acquire deals, evaluate your results, and then you feed that back into your big why, right? Okay, next steps. I highly recommend reading this book, either reading it or listening to the audio book, The Millionaire Real Estate Investor. It's a great investment. Talk to a mortgage professional, get pre-qualified, talk to your financial planner, a professional, and come up with a plan that you can stick to. Big models, big habits, remember? Any questions? Please put them there in the chat. And again, it's been a pleasure sharing this book with you. I hope you enjoyed learning this material as much as I enjoy going over it. It's fantastic material. I'm here to help. My team and I would love to help you build your real estate portfolio by making offers, by finding properties, and increasing your net worth over time. We're in the game. We can help you. We've got the resources, the lenders, the attorneys, the accountants that can help you with this. If you need any, contact me right here. This is my mobile phone. Our team is ready to help you. My email is right there, jason@jasonsmithshowcase.com. Website, if you'd like to see a bit more of what we do, it's showcasemiami.com. Wishing you all success. Thank you very much, and look forward to meeting you in person. Take care.